Hey, welcome to Financial Revelations. I am David Safransky, your host. We do the podcast on a weekly basis, most weeks, unless we're traveling or out of town. And we are in town, so we're doing the Financial Revelations podcast. Of course, if you have questions, if you have comments, you can always email them to Joshua at epsf.com. Joshua at epsf.com. Joshua is going to put it up right here so you can see it. And you can always email us there. You can also request to be on our quarterly newsletter, which comes out, it'll be out around April 1st. And there's a lot of good information in there about our take on the markets and what we are seeing in the markets, what we think is going to happen. So if you want to get on that, send that email to Joshua at epsf.com. Today we're going to talk about what actually happened with the stimulus plan. Now, my wife was reminding me yesterday that she had watched a recent podcast, and I said, I don't think it's going to be $2 trillion. I think there's going to be a compromise. Well, I was wrong. There was no compromise at all on the stimulus plan, and we got $1.9 trillion of stimulus. It's already in the market. People are getting it in their bank accounts as of yesterday. And this is a lot of money. It does present some really good things that I think are going to happen and some problems along with it. And I'm going to talk about both of those. So the good thing is that people will have cash to spend. Now, most people are going to get $1,400 per person. And if you have kids, you're going to get a check per child. So I talked to somebody this morning, had $9,600 in their checking account yesterday. So for them, it's a windfall. They're going to spend a lot of that money. They're going to save some of that money. They're going to do a lot of things with it. And in a sense, that's going to be very accretive to the market. It's going to help stocks. People are going to go shopping. They're going to do things that they weren't doing necessarily before. And so those are really good things for the market. That will help asset prices. So if you are an owner of stocks or mutual funds, or real estate, you're going to benefit quite dramatically, I think, in the next several months because of all the money that's going to be put into the economy. The other thing is that the COVID recovery is very, very real. So last year at this time, the market was falling 3,000 points a day and everything was shutting down. We were really in the depths of COVID. We didn't know what was going on. I can remember my parking lot, for instance. There were usually two cars, mine and whoever was working the front desk that day. That was it. There were no traffic jams. It was easy to get back and forth to work. Well, those things are starting to ebb in the right direction where I flew this week. Airports were crowded. There's not as many flights, so they're kind of mashing everybody together at certain times, but it was still very crowded. Parking spots were less at the airport. These are all things I notice, and as I go into stores, I see a lot more people in stores. So the COVID recovery is very real. It's happening. That's also going to be really good for the market. Now, the downside to the stimulus plan is it's $2 trillion. This is more money than we spent in all of World War II, just to put it in context for us. It's a lot of money. If unemployment stays persistently high, which it could, you're going to see inflation. And we're already seeing inflation in fuel prices, housing prices, lumber prices. You will see it translating into food prices shortly because the food has to get to the market somehow. And usually it comes on a ship or a truck, and it's going to be on a truck at some point in time, and it's going to get delivered. It takes gas to deliver those things. So you're going to see some food inflation. As of right now, as of today, the 10-year Treasury is at its highest point in over 2 years. So these things are pointing to slightly higher costs. And if you have persistently high unemployment, you're going to see inflation at a faster pace. And that would be the downside to the stimulus plan. I think something had to be done. And I'm glad that we did a stimulus plan. I think it was probably a little bit more than twice the size that it needed to be, especially because a lot of the money isn't even getting spent this year, in the year that we need it the most. And that is a little bit disappointing to me. So after we did this with absolutely no compromise, they're talking about an infrastructure bill, which normally would have been a really good thing. But we've borrowed so much money and we're talking about bills that are all borrowing money again, that they have to talk about tax hikes. And the tax hikes are real. The tax hikes are coming. It can be done via reconciliation, so you won't need 60 votes to get it out of the Senate. It could be very problematic. Capital gains tax is going higher. Stepped up basis going away. 1031 exchanges gone for right now. In general, and I want to put this in context for you. If we look at this in a very simple terms, if when you want to stimulate the economy, if you want to get capital moving, there's two things that you could do. You put money in, like they just did with the stimulus plan, and you cut taxes. That gets capital moving, flowing, transactions happen. So if you do the opposite of that, if you take money out of the economy and you raise taxes, the exact opposite thing is going to happen. You're going to slow down the economy. You're going to slow down transactions. A lot of people are going to wait you out. If capital gains goes up to your marginal tax bracket and you're in the 40% tax bracket, you're just not going to sell. So you're going to see a slowing economy, and a lot of the people that are in position of power now were very satisfied with the 1% growth rate several years ago when President Obama was in. They were very satisfied with a 1% growth rate. Well, that is very difficult to get yourself out of debt with a 1% growth rate. In World War II, at the end of World War II, we had a debt load that was about the same size to GDP as we have right now. The difference is, for the next 20 years after World War II, we ran a trade surplus with every country we traded with because we had just gotten done bombing them. They didn't have the means of production, so they had to buy stuff from us. We were more than happy to meet those needs, but that's how we got out of that debt. We were running a trade surplus with everybody. That is not the case right now. I don't know of any country right now that we're running a trade surplus with, and some of that is good because it tells you that you're a very wealthy country. You can buy stuff from anybody, and when that happens, you really have a lot of choices, and it's probably unlikely that we're going to run a trade surplus with anybody right now. But that being said, we don't have the same capacity to get out of debt as we did before. And so managing your debt load is very, very critical. If interest rates keep rising and we have to float debt at higher interest rates, it's going to be problematic. It's going to be inflationary. And inflation is a killer to any economy. So we have to be really careful right now. The Fed is going to do everything that they can to suppress interest rates, but they can only do that so long, and they only have so many tools in the arsenal. When those tools are used up, we're in trouble. So here's what's going to happen. As interest rates rise, these high-tech trades, the higher flyer trades are kind of coming off a little bit. It could be a buying opportunity. That's the way I look at down markets. Really good companies on bad news really interest me. So as those tech trades come off, I'm going to start looking closer at them and buying best of breed. The other thing that's going to happen is some of these older line companies that have been around for a long time that aren't tech oriented, they might have tech in them. I think of a Procter & Gamble. There's a lot of technology in Procter & Gamble, but it is not a technology company. It's a cereal company. It's a diaper company. It's a soap company. It's a lot of things. Tech isn't one of those things that you would think about with Procter & Gamble. But I like those companies. I like Boeing. I like Bank of America. I like the big financials in a kind of a transitional trade as interest rates rise and some of those high-flying names come off a little bit. But I'm still looking at those. I'm still looking at those high flyers. I just want to get them at a better price. And that's kind of the natural push and pull of investing is this is in favor, this is not in favor. All of a sudden, this is in favor, and this is not. Well, when the right hand was out of favor, you were buying those things. You're buying them at a good price. And that's what we're going to be able to do with technology here over the next couple of months. And it might be the rest of this year that technology doesn't really trade very well. It doesn't mean it's going away. So Apple, Amazon, Baba, Palantir, all those big software companies, Microsoft, all the big names that you know. And I'm not saying that you should buy those because investing is kind of a personal decision. You have to base it around what your needs are, not just because it's a good buy. So if there's a company that is aggressive and the price is right, it doesn't mean that you should buy it. And I would encourage you to talk to a financial advisor, or somebody in the profession. You don't have to have somebody manage your money, but you could pay for advice. You could say, why don't you take a look at my portfolio? I'll give you a couple of $100 and tell me what you think. And then you go on your merry way and maybe you institute some of those ideas, maybe you don't. But just getting that second opinion is usually a really good idea. Doesn't mean you have to do anything with it. So I like that option of advice for a fee and then you decide what to do. Not a bad way to go. As we get longer in the tooth with the stimulus plan, as that money gets input into the economy, it's going to take a little while because it is $2 trillion that we have to sell bonds for. We don't have that money. We got to sell those bonds. It's going to take a while. As that happens, I'm going to be very interested to see the money supply, how it's expanding, the velocity of money, how fast is it changing hands. And then very shortly, I would say probably June, July, we're going to have a concrete tax plan from the Biden administration, and we're going to be able to evaluate these tax increases that are coming. When President Obama got elected and he was doing some things that conservatives didn't like, he said, elections have consequences. And he was so right. This election had a lot of consequences, and they're going to continue for a while. If you're an investor, you might not like a lot of them. We do have to deal with them. So there are we could talk about the way we would want them and the way things are. And we have to deal with the way things are, and that's what we're going to do. Now, in slower growth economies, it's true. It's a little bit more difficult to make money. You have to really drill down and get granular with your stock picks and your mutual funds and your ETFs. But we are able to make money in weaker economies. I don't think we really have a weak economy right now because we are, again, in the COVID recovery. But it's going to be a little bit more challenging in the next couple of years, I think, to make the kind of money that we were during the Trump administration. We're just going to have to work a little harder. We're going to have to be a little bit more diligent, but it can be done. So don't lose hope. Even in really bad days in the NASDAQ like we're having today, don't lose hope. We're going to make money. I feel confident about that. It may be in different ways, but it's still going to happen. I tend to like to focus on, in times like this, especially rising interest rates, in dividend-paying stocks. They have been around for a long time. They have a product people use. They have enough capital where they don't have to reinvest everything in the business because they're sending it back to shareholders. And the shareholders are us. They're people. I think a lot of administrations miss the fact that a lot of people own stocks, bonds, mutual funds today, whether it be in their 401k or just outright. And so when they talk about taxing those transactions, they're hitting a lot of people. So I expect there to be some pushback on the tax plan, but I also thought that about the stimulus package, which came out exactly where they wanted it. So it's going to be interesting to see how the tax proposals work, and I think we'll have more information in the coming months because they're just starting to talk about them now. So there's going to be a lot of trial balloons. But as we talk to you more, we'll have more information on that, what they're thinking. And I'm going to do something probably that I haven't done in a while, and that is I'm going to implore you to talk to some people in power, to probably write some letters, make some phone calls. I always want to be respectful with our elected leaders, so we don't need to call them names, even when we want to. Not a good thing to do. But be respectful. Just tell them, I don't want to pay higher taxes. I want to grow our way out of this economy, or out of debt, and we can do that if politicians spend less money, pay off debt, and aren't always trying to get reelected with a check in their hand. And, politicians love to get reelected. I always thought that must be a great job because everybody's working so hard to get there. I don't know what they're doing there, but they're working hard to get there. There's got to be something to that. So I want to grow our way out of debt. And we can do that. We have done that before. We can do it again. But at some point in time, we have to stop spending every dollar that we take in. It's not going to be this year, mainly because of the COVID recovery. It is not going to be this year. But most definitely, it could be in 2022. We will be out of COVID by the time this year is over. More vaccinations are happening. More people have gotten the virus. And I just read today that getting reinfected with COVID is not very likely. So we are going to get to a point of herd immunity at some point in time. And, I don't know if we'll ever not wear masks flying. I don't know if I'll not wear a mask flying, but we are getting closer to that date. We are getting closer to a full recovery. That is real. It is happening. And I want you to maintain hope. And we're going to continue to give you guys information that will help you make money. As always, if you have questions, comments, or anything that you want to talk about, Joshua@epsf.com. And it's going to be right up here over my massive forehead. So don't be afraid to send in emails and get on our newsletter. It comes out quarterly, and that'll be coming out in April. Probably April 1st it'll come out because I think I'm traveling on the 2nd, so I want to get that out. I look forward to talking to you guys. Thanks for listening, and forward this on to your friends. Financial Revelations Podcast, I'm David Safransky. Thank you.